Okay, let's talk about the markdown phase. Now, if you're inclined to short stocks, I don't do much stock shorting myself. I don't think the odds are with you as a stock shorter unless you're a market maker. But if you can identify properly the phases that a stock is in its price cycle, you can sell short just like you can buy long as you get the phase right, and you're going to have a pretty good chance of being profitable on the trade. So what does a markdown phase look like? There's a similarity between distribution and accumulation, and the similarity is during both distribution phases and accumulation phases, the market makers are rotating their positions and they are accumulating a new position in anticipation of the next phase. During distribution, they're loading up on shorts. Stock prices will tend to fall faster than they rise. In a rising market, there's lots of price support, there's lots of excitement, but there's also market makers selling into that price rise. That's the whole point of the markup phase. This creates a nice solid floor for prices that you can move your sell orders up. That's why the system works. The markdown phase, Wall Street has no incentive at all to support the price of a stock. In fact, the faster it falls, the happier they are. Because there's no incentive to support the price of the stock, the price movements tend to be more violent and they tend to be bigger. And then, once the public is totally discouraged and there's no more selling pressure in the stock becomes boring. Then the markdown phase really begins as the price gradually falls every day because there's no buyers and the market makers are short and they don't really care. Let's look at a chart. Now, this is that same stock that we looked at before when we identified at the beginning of the distribution phase. Now, this whole time period right here is distribution. This whole time period. And this distribution phase went on 1, 2, 3, 4, almost 5 months of a distribution phase preparing for the markdown phase. Now, on this particular chart, we see that there was a spike in on-balance volume at the end of June. But what happened was called a failed auction. Here's the original high where distribution began. Then you have this huge spike in volume, but the price was not able to make a new high for that security. And what that tells you is that even though there was a volume spike and on-balance volume went up, because this was a failed auction, we're highly likely to enter the markdown phase next. So many traders would take a look at the two lows and draw a line that's called a support line, and then they would sell a break below that line. And that would be the right thing to do if you believe that a stock is in distribution and prices are moving lower. So if you were trading this based on the methodology that I teach, you probably would have went short somewhere in this general area. We're looking again at a chart of the same security during a different time period. Up here in this corner, that's the area that we already identified as being distribution. This is the line where most people would trade it short. And this is the subsequent markdown period. But also this period here could be called distribution as well. Sometimes you will move from one distribution period into another distribution period, just like you can move from an accumulation period to a higher accumulation period before the real markup happens. But a key thing that you can see on this particular chart is the reverse of a shakeout. This is called a sucker rally. And what a sucker rally does is the same thing that a shakeout does. They will run the price up to activate all of those buy orders to accumulate as much short stock as possible before the distribution phase ends and the markdown phase begins. Now, what happens if you get caught in a sucker's rally? Well, you're always going to trade with a stop loss. So if you're watching this distribution period and you believe that it's actually accumulation, so you place your order to get in and the prices move up and you get in and then you get suckered and the prices begin to fall, don't worry about it. Get out of the stock. That's why we place stop loss orders. And then ask yourself, I thought this was going up, but actually it's going down. Does that mean that that period that I thought was accumulation was actually distribution? If you're looking at a distribution phase on a stock, what's the next phase? Markdown. So if prices are already falling, you're in the markdowns phase. Maybe you have an opportunity to reverse your position, go short, get in sync with the phases of prices, and trade the same stock short and make back what you lost on the long side. That's a decision you get to make. I don't typically trade short that often, so it's just not really something I do a lot of. But had you've done it, this particular stock went from $8 a share right after the suckers rally, to 38 cents. That's a pretty good move. You probably wouldn't have stayed in for the whole move because there was another head fake here which looks a little bit like accumulation, followed by a sucker rally from $1 to $2, and then whatever trauma took place here, but to actually finally kill the stock. And as you can look, stocks die the same way they're born, with lots of excitement. In fact, there's actually usually more excitement when a stock dies. Look at how heavy that volume is compared to over here, compared to the rest of it. That's everybody running for the doors.